Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is 10:30 a.m. in the UAE, and we have Brent crude oil dropping again below $75 a barrel in early trade today in Asia after the closing above $75 yesterday on Brent. This is, and that was the first time it closed above $75 for some time since we saw that trough in early September of 69, where they closed at 69.19. But climbing up in the sort of interim 2 weeks back above 75. Today, a little bit off, but still. Interday trade has seen it pop up and down above 75 again. Let's kick off this morning and welcome back to the table Sarah Akbar, Chairperson and CEO of Oilserve Kuwait and Non-Executive Director of Petrofac. Sarah, it's great to see you again, and I hope all is well. I wanted to kick off by asking you your thoughts on the OPEC World Oil Outlook yesterday. Which is obviously a mid and long-term forecast, very, very bullish outlook to 2050, where it sees oil demand growing by nearly 20 million barrels a day above 2023 levels, which is last year, and in the interim, sort of see as much as that 10 million of that coming in this decade alone. These are very, very ambitious targets. They're totally out of line with not only the other multilateral agencies, but ExxonMobil, even, you would imagine, who are in the bullish zone of oil production. So I just wanted to get your initial reactions to that World Oil Report, which of course comes out every year. It's a very important research document.
Good morning, Sean. It's nice to be back, on this podcast. Yeah, I thought the report actually is, if you remember the last forecast they had versus this forecast, it's only like 3 million above the previous forecast they had. So they have not gone beyond the initial assumptions they had in the reports from before, which I believe are very, very realistic. If you look back, you will see that OPEC almost every time got it right whenever they had forecasts. And because they actually look so much into the details and factor in a lot of the uncertainties as well that we see in the market. For example, currently the world is looking, the substitution for oil and gas is renewables and electrical cars and all of that. But we know for sure, under this current environment of change and environmental change and aggressiveness of the environment, you cannot rely totally on those sources for energy. And the only reliable source that you can utilize under all circumstances is oil and gas. And as you know, even the environment is becoming more vicious all the time. So what will give you the reliable source of energy with all the growth that is expected in the world economically, the population, and all the requirements for energy? The only source that is really reliable is oil and gas. And this is one of the elements that being considered to compensate for all the investment that is going really into the renewable. And if you notice, last year, it was the first year where investment in renewable surpassed the oil and gas. And I think this report, the main element that you should take from this report is we should keep investing in oil and gas because that will stabilize the market, that will stabilize world economy. And like I said before in every podcast, the role of OPEC in all of this is providing security of supply and security for energy for all. And this is part of the security to ensure that we are timely investing in oil and gas so that we can deliver these results to the world. So this report falls directly into that line of thinking. And I think it is very valid report, and I believe OPEC. I believe what they do. It's not just a marketing document that they use or based on. It is a serious report that they are driving people into investing in oil and gas so that we secure the energy supply to the world, secure a reliable source of energy to the world, and that's the most important word in this report.
Salah Yilmaz, Senior Energy Equity Analyst at Bloomberg Intelligence. Salah, welcome your thoughts and reaction to the report, because, of course, it is both notable in the current year that we are in that OPEC is double the average. If you like, we're now in the end of third quarter of September. The sort of consensus and the reality is about a 1 million barrel a day demand growth this year, even less than that. And yet OPEC are still above 2 million barrel a day growth for this year, as of their last report a few weeks ago. Your thoughts on that outlook, that consistency, and the mid and long term outlook for OPEC? Is it credible? Will your sort of international oil companies rely on that? Your thoughts?
Hey, Sean, it's great to see you, and thanks again for having me on. I mean, as you mentioned, I think when we look at the long-term outlooks, it's pretty fascinating, the divergence that we see between different agencies. But what's more fascinating, as you said, is even the current year, where they can't seem to agree on where oil demand growth will be for this year. And as you say, IEA currently, I think, is expecting just below 1 million barrels per day. And I mean, we are almost in the fourth quarter, and still there's this disagreement about this year where OPEC expects about double of that amount, which is quite fascinating to me. And generally, I think one could argue that both agencies are perhaps talking their book a little bit, and perhaps what we should be looking at is somewhere in between, and that goes for this year, and that perhaps goes for the mid-term and long-term as well. Because when you look at the IEA, they think oil demand may be peaking at around 2029, and OPEC sees oil demand not peaking all the way into mid 2040. And I mean, who knows? They will probably be both wrong, and perhaps we should be looking at peak oil demand perhaps somewhere in between as well. We survey our clients, and we actually just closed our most recent survey where we had 176 respondents. I mean, we target Bloomberg Terminal users, energy specialists on the Bloomberg Terminal, and we once again had an oil demand question, and the consensus there seems to be somewhere between where IEA thinks oil demand will peak and where OPEC thinks demand will peak. So, and I mean, you asked where perhaps oil companies are positioned in this. And once again, I think what they're looking at is probably somewhere in between. They seem to think that 2029 might be too early, but they are positioning themselves for a world where perhaps oil demand is not growing all the way to 2050 or beyond. And they are trying to shift their spending and position themselves a little bit better for a perhaps different future where oil demand may not keep growing beyond 2040 and forwards.
Let's welcome Alan Gelder, Downstream Global SME, VP Refining, Chemicals and Oil Markets, Commodities Research at Wood Mackenzie. Alan, one of the sort of outcomes or destinations that oil producers are looking at was, as we see electricity taking over a lot of the mobility opportunity, particularly in China, but that the demand growth is going to come from chemicals and other opportunities in that space. Your thoughts on the OPEC Plus report and how much of that they can rely on coming from chemicals, and maybe many of us don't see that demand growth in mobility, but perhaps it can come elsewhere. Your thoughts on the other demand centers than mobility for this huge, ambitious forecast?
Morning, Sean. Thanks for the invitation to be on. Pleasure to be on. Just looking briefly at the OPEC report, when we're talking about long-term aspects, it's sort of the key things that drive differences in the view is effectively economic growth levels, GDP levels, population is probably very similar, and it comes down to then sort of end uses of oil demand. And the IEA is much more aggressive on the decline in mobility, but across all the IEA and OPEC, they're both in agreement that petrochemicals is the key source of oil demand growth as we go forwards. The relativity I haven't really looked at in detail, but those key drivers remain the same in that as we go forwards, oil demand growth is increasingly on petrochemicals, modern mobility, and that's really rising populations, rising incomes, rising urbanization, and rising standard of living, all of which result in greater petrochemical demand. So that long-term mega trend, all of the agencies agree on. It's then driven by the differences in sort of assumptions around GDP, those sort of things. Is my expectation for the big differences that we're seeing.
Well, just, I mean, to take that forward, I mean, obviously you're focused a lot on the downstream area. What is the impact about currently, given that we are in a year in which it is the end of the third quarter and we have such a massive divergence between where the market's at and the general consensus being 1 or under 1 million barrels a day versus OPEC at 2? What is the impact on outlook for downstream investment and utilization when you have such divergence, not only in the current year, but the medium term for oil demand? Is anybody going to put $20 billion into an integrated refinery and petrochemical complex?
Not many would be the easiest way. No, that's the easiest way to answer. It's not many, because we've seen reasonably strong petrochemical demand growth, petrochemical feedstock demand growth this year. The challenge has been actually that's been masked by a huge build in capacity in China, which has actually meant typically the classic of petrochemical margins strengthen because petrochemical demand is strong. That's been decoupled given the huge amount of capacity that we're seeing. So we're still seeing petrochemical feedstock demand growth, but you don't pick it out from the activities and the utilization levels in sort of Europe or Southeast Asian petrochemical facilities because they're struggling with the investment that's happened in China. But this concept of peak oil demand happening at some point, probably next decade, we've got early 2030s. What it's doing is basically nobody's really looking to invest in fuels refineries anymore. It's all some form of petrochemical integration. And the challenge with the oil demand outlooks that all show transport going down is actually that's not something that looks particularly attractive. And then who is willing to put down those significant sums? Previously, it's been sort of a number of Chinese companies that have back integrated, the Henglis, the Rongshens, that have put significant capital down to back integrate down their value chain and really disrupted the chemical market. So we've got petrochemical supply growth coming, but then that sort of eases in 2025, 2026. Then people will start to think again. It'll take a while for people to look at investing in petrochemicals because margins now in petrochemicals are so poor. Yeah.
Sarah, just coming back to the current period that we are now in, obviously September has been a rather volatile month for oil markets. We saw at the beginning of the month Brent through August dropping and earlier in September below 70 close. Now we got back above 75 yesterday on the close. Your thoughts on what are the dynamics currently impacting the market and what do you think will give it direction as we now go into the fourth quarter?
Well, Sean, I remember 2014, we were in a situation very similar to where we are today. So OPEC has closed capacity at this point in time because they're trying, like I said, to stabilize the market. But at the same time, you have a lot of supply coming out of Latin America, the US, and elsewhere that is taking all the growth that is coming. So OPEC is sitting at the point where they are thinking, should we go back to that kind of environment, 2014, where we had the same story with the shale oil from the US, and if everyone remembers what happened after that. So at this point in time, we are living a similar kind of environment where OPEC is restraining themselves, where all the extra capacity, all the benefit from the stabilization of this market at these levels is gained by other entities that are not part of this OPEC plus story. So that's So that's what's driving them to think, early next year, we should put back some of that closed capacity into the market, especially with countries like Iraq, like UAE, like the Saudis. I think we may be coming to a similar situation, which means that probably next year will be a suppressed market for the oil and gas simply because of these facts. And if you remember what happened after 2014, a lot of the shale production in the US went down and the investment went down, and then they had slowly to, and it goes down fast, it comes up very slow. So that's the kind of cycle we are going into. And I think that is the kind of environment we are living in. But, this is really complicated by the geopolitics of the region. And I really don't know where we are going with this war with Lebanon and this, I see, many countries in the region dragged into this war as well. So that will have a huge
It's certainly the geopolitics of both Ukraine and the Middle East is come back into a very ugly place. I mean, it's always been in an ugly place, but now the ugliness perhaps is growing. Ukraine has invaded Russia. Russia's hitting Kiev. Now Israel has demolished Gaza. Now it's looking like it might carry out similar impact on Lebanon. These are very serious moments, and yet the oil price remains relatively subdued to where this is going. Sally, your thoughts on the direction of travel for the oil markets? We've recovered, not insignificant on percentage terms, from closing under 70 2 weeks ago to now closing above 75 yesterday. Does this momentum continue? Is there now wind in the sails of this market going into the fourth quarter?
Yeah, I mean, there seems to be a little bit, as you mentioned. I think there are a couple of factors playing into this. I mean, of course, the geopolitics, and I mean, you're right. In the last year or so, we've had significant geopolitical risks, not only in the Middle East, but also between Russia and Ukraine, and of course in Libya, where we did have some actual disruption. But a couple of reasons why we didn't really have much of an oil price impact is, one, for the most part, we haven't really had much of a supply disruption, at least in the Middle East. And two, I mean, there's significant spare capacity that even just the core OPEC member nations are sitting on. And when you look at the wider OPEC Plus, I mean, there's a significant, a meaningful amount of spare capacity. But beyond the geopolitical developments, and again, we think that there's still a negligible geopolitical risk premium on prices at the moment. In the last day or so, we've had this adrenaline shot, as the market is calling it, of the Chinese stimulus into the market. This has had a positive impact, not only on commodities, but also in the wider markets in the US and Europe. Perhaps to an extent, this OPEC report giving a little bit of an optimistic report. Again, I mean, I think the market is probably taking this with a pinch of salt, but nonetheless, this is a bullish and upside catalyst for the market. When we look at the past week, the preliminary reports are showing another week of drop in US crude stocks by about 4 million barrels in the past week, which I think would be bigger than what the market was expecting. And it would, I mean, if confirmed, if this data is confirmed, that would mean that stocks are at their lowest level since April 2022. And I think to an extent, market is watching the storms, and the tropical storm of Helen seems to have strengthened as it's moving towards the Gulf of Mexico. And I think it has already triggered evacuation of some oil and gas platforms. So all of these combined, I mean, there are a few bullish factors now in the market, but at the same time, the headwinds that we've been talking about are still there. You know, when you look at demand, especially China, of course, we have the stimulus now, bazooka, some are calling the stimulus package. But I mean, of course, the impact on actual oil demand, uncertain. Execution of this package would, of course, be very important. And of course, beyond demand, market is still watching the very robust non-OPEC plus growth that we've seen. And we often talk about the US, but of course, we need to watch Canada, Guyana, and Brazil as well. And
is bazooka a big metaphor these days? I'm not sure. We'll see what the Israelis can drop on 2,000-pound bombs on people in tents. A bazooka seems like a little thing, but nonetheless, not to digress. Alan, the outlook for refiners. We're seeing refining runs being brought down quite a bit, and not because of maintenance, but because of the economic return. What's your outlook for that changing, that drawing in more crude and more production into the fourth quarter opportunity, particularly in Asia?
Yeah, thanks, Sean. So what we've got is our outlook for crude runs as we go through to the rest of the year is we've seen economic run cuts, Europe, Asia, Southeast Asia in last month or so. Given the weakness of margins, we've got crude runs coming down in October because we go into maintenance. And then, since this is what gives us the view that actually the fundamentals are supportive to the oil price as we go through Q4, is because we've got global crude runs increasing about 2 million barrels a day as you go into like November and December. So that will act as a bit of a draw. And we look at our high frequency data, we've got US inventories coming down and global crude commercial inventories, though they're volatile, they're on quite a downward trend. So for us, the backdrop is actually supportive to crude price, not necessarily in October, given that sort of maintenance factor into crude runs, but more towards the end of the year. So we do think it's going to flirt with the classic 80 number and break away from your 70, the 75 that we're there where we are now.
Let's go to the survey question and see what the view of the room is here on the OPEC report. OPEC sees global oil demand growing by 10 million barrels a day from 2023 to 2029. Do you agree with this 10 million as this is in the report yesterday? Do you think it might be half of that? No, it'll be less than a third of that. Or no growth as we are at peak demand already or close to it. Your thoughts on where this demand story is going? I didn't choose 2050 because I still think that's a bit out there in terms of a time horizon to make any sober assessment. But in the immediate, we're talking 5 or 6 years now, that this 10 million barrel a day growth over 2023 levels. This year, 2024, it would appear that the number will be one of that 10, a little one or give or take. So there's one of the 10. So we need 9 more from 25 to 29 to hit that number. So what are your thoughts? Maybe half of that. We have some BP are already calling we're in the peak oil demand era. China at CNBC has said it's closer to the end of the decade, but nonetheless, China sees peak oil demand at the end of the decade. So maybe half of that, maybe a third, all of it, no growth as we already peaked. So welcome your thoughts on that. Sarah, looking out to the regional development and that scale of we're seeing, capacity building going on in the Gulf, obviously most notably in the UAE in recent years, but now also in Kuwait. Given those demand growth numbers, what is your outlook for sort of field operations? I mean, you'll be very busy.
Right. So everybody is very busy and throughout the region. The activity level has really dramatically increased in Kuwait, and we see that in UAE as well. Now, the story is a little bit different in Saudi because since they have reduced their target by about 1 million barrels, so they are completely focusing on gas development. So there is lots of activity going into the gas fields, but really the oil fields are really being shrunk. The activity level has been shrinking. The activity level in Iraq has been increasing as well because, the new licensing rounds they have given out and the efforts they have in maintaining and increasing production is continuing. So as you imagine, the national oil companies of the region are still busy. Their plans has not changed except for the Saudi change in the forecast actually in their target. So the target has gone down. But other than that, all the rest of the companies or the rest of the countries in the region either are increasing level of activity or maintaining the same level. And this has been typically the behavior throughout all the cycles. It's never affected the national oil companies. They have targets. It's a long-term target, and they just work towards it, no matter what changes in the market. The flexibility they have, the buffer they have there is huge. So that's what we are seeing.
Salah, in comparison to that, we're seeing the majors being quite conservative about where they deploy capex, and with the takeover of the shale patch in the US by the majors, they're showing great discipline there and basically not adding any capacity this year. Where do you think that goes with particularly the American majors and their appetite to add capacity in the sort of immediate period, or at least deploy the capital to start adding capacity? And within the shale patch, of course, you can add pretty quickly.
Yeah, I mean, we expect the same type of trend. And when we look at analyst expectations on the Bloomberg terminal, from now all the way to 2028, for the big majors, including the US ones and the European ones, CapEx is pretty much expected to stay around the same level. And to your earlier point, I think essentially the deal that these companies were making with their shareholders were, they promised their shareholders that they would keep this capital discipline, even as their cash generation has gotten better, even as, they had more capital to deploy. They instead had dividends that were restored to pre-pandemic levels, and in some cases beyond. And what they've been doing, have been a lot of buybacks, because they promised their shareholders they would do more shareholder returns rather than invest back. And especially in the shale space, where they had this cycle in the last decade of investing back a lot of that capital, a lot of that money that they were making, and that didn't end so well for them. And this time around, shareholders were asking for more returns instead of investing back in the shale patch, and that's what these companies are doing, and that's what we saw since the pandemic, and that's the trend that we expect to see in the next few years.
Alan, the last word to you. I wanted to get your thoughts on, obviously we've seen the Chinese government itself in the recent days, and yesterday the bazooka of stimulus that they included a 50 basis point interest rate cut in that, of course, following a week after the US Fed did the same. And we've seen across Europe the declining cost of money and the ECB and so forth. And so my question is, how is this likely to impact as we move into a cheaper price for money for very big capital intensive industries like downstream chemicals and refining and all of its associated activities, how that's likely to play? The Fed have signaled quite strongly that they're willing to go another big cut later in the year.
I think people will, as Sally was talking about, display capital discipline. What we're looking for is the easing of interest rates to improve economic growth. We've got stronger growth next year, and that's really quite important to get strong oil demand growth, so that oil demand growth outpaces non-OPEC supply growth, because if it doesn't, OPEC is in a very difficult place. A big uncertainty that I think we have to acknowledge for next year, and we've done a bit of work on this, is if the US imposes tariffs on imports, that will be quite negative for US and global economic growth, and hence oil price and refining margins. So that's quite a political risk that may emerge depending upon the results of a certain election in early November.
Yeah, and certainly on top of that, if that comes with the imposition of very strict sanctions again, and curtailing oil supply, you could see also price move in certain directions. There's the survey result related to this room. Maybe half of that seems to be the overwhelming consensus. We'll see if that's concurred outside of the social media channels. But clearly a very important report. As Sarah said earlier, it's a big document and a very worthwhile read into the deep granular detail in which OPEC Plus, or not OPEC Plus actually, OPEC on this occasion bases its forecasts on. They've been doing this a long time. They have access to a lot of granular information, and definitely well worth paying very close attention to their details. Thank you so much, Sarah Akbar. Great to have you back Don't let it so long next time. Alan Gelder, thank you for joining us. Salah Yilmaz, thank you as well. Great to have you all three this morning, the day after Brent closes above $75 a barrel. Will it hold that? Will it consolidate above 75? A big recovery in 2 weeks. $5 on 70. So will that trend continue through this week? We'll have to wait and see. There's glass half full reasons why it should or could, and there's clearly glass half empty reasons of why that took it down to 70 in the first place. We're getting very busy preparing for our Big Energy Markets Forum next week in Fujairah. With the 300 delegates coming. Unfortunately, I don't think Sarah Akbar is one of them. We will miss her this year. It's always great to have her voice at the table. But thank you, everybody, and see you soon.
Thanks, guys. Enjoy the rest of your day.